All right. Good morning, everybody. Good morning, all you magnificent melonheads of the world. Happy Friday, everybody. Today's February 7th, 2025. Happy Jobs Day. We got the non-farm payrolls report, came out just a few minutes ago. And this one was a little bit difficult to interpret. I think the initial reaction by the market was that this was a bad jobs report. And then people took a look a little closer and said, you know what, this is actually pretty good. So what are we talking about? The headline number, the U.S. economy added 143,000 jobs for the month of January. Taken by itself, if we stop reading right there, this is disappointing. And I think the market reacted that way. The algorithm saw that 143 number. They ran through their little algorithm. They said, nope, that is below the 170,000 that I was told to expect. And so sell. We saw the market take a step change down. And then within a couple of seconds, people started to realize, oh, wait, take a look at those December job revisions there. Oh, plus 51,000 in December. Oh, look, November was revised higher by 49,000. What is this? 100,000 in cumulative upward revisions to prior month job numbers? Since when does that happen? Haven't seen that. We've seen plenty of big revisions to prior numbers, but they've almost always been revisions down. So when we factor those 100,000 cumulative upward revisions into this jobs report, so it's actually a really good number. 243,000 gained if you factor in those upward revisions. And I think slowly the market started to realize that, and then things swung back more towards pretty much where they were. So the market is having a hard time with this jobs report. Is it bullish? Is it bearish? What about the Fed? Does this say that the Fed is going to come do this now, or is it more likely to cut, or is it less likely to cut? Honestly, I don't think this report by itself really informs that much what the Fed is going to do down the line. I think the Fed is probably going to stay put for a little while here. I do think, though, looking backward at this report, when we see that December number has now been revised up over 300,000, it's pretty obvious that that knee-jerk 50 basis point cut in September by the Federal Reserve was a mistake. I think we can all agree on that now. I mean, I'm sure the PhDs at the Fed are looking at all the economic data and they're like, well, yeah, the jobs were really good and this and that. And, oh, inflation rose after that too. Yeah. But you know what? Did you see those poll numbers for Donald Trump? I mean, we had to cut 50 basis points, right? Oh, sorry. We're not supposed to say that part out loud. But in hindsight, doesn't it kind of look like that 50 basis point cut in September was a little bit ill-advised, just maybe? Or, you know, hey, I mean, it might take us 7 or 8 years to reach our arbitrary 2% inflation target. In my opinion, it was a mistake. So let's see. We got some other data along with this jobs numbers. Unemployment rate dropped to 4.0% from 4.1% in the prior month and 4.2% the month before that. So we've got unemployment is now trending down. The labor force participation rate actually ticked up a little bit. That's pretty good. 62.6% versus 62.5. Now, if you are the perma bear, and no matter what happens, if you're just looking for that little bitty data point that says, aha, this is bad, well, there is something in there for you as well. Weekly hours dropped to 34.1 from 34.3. Now, that may not sound like a big drop, and it's not really that big of a drop, but 34.3 has kind of been the floor for a couple of years now. We are now below that floor, 34.1. This is our first data point down in that range. Typically, big cuts to weekly hours precludes job losses. So again, this is a stretch here. If you're really desperate for the negativity in this jobs report, you could point to that weekly hours being cut and say, that's indicative of future problems in future reports. But for now, guys, a slightly disappointing headline number, more than offset by some really big upward revisions, which is very out of character for this Bureau of Labor Statistics. I think on the whole, you got to look at this as a positive for the health of the labor market any way you look at it. Some of the categories we saw big gains: healthcare, 44,000. That's a function of the aging demographics in this country mostly. Retail trade up by 34,000. Social assistance up by 22,000. And of course, government jobs up by 32. Other than that, most other categories were pretty much unchanged. Other news we got going on this morning. Amazon reported their earnings yesterday. It was an earnings and revenue beat, as Amazon is prone to report. But the big story, there was two big elements of this story here that has Amazon down a little bit pre-market this morning. The first, even though their overall revenue beat, their AWS revenue, Amazon Web Services, their cloud division, that's where their data centers lives. That's where their AI investments lives. Their data center, their AWS revenue was a slight miss, 28.79 billion versus 28.84 billion expected. All right. So, and I do mean a slight miss. That was ever so tiny. That being said, when your stock has rallied 150% over the last year on expectations of all these investments in data centers paying big dividends, and then your data center revenue misses expectations, your stock is going to sell off a little bit on that news. All those things considered, Amazon stock is actually doing pretty well here. Now, then Amazon followed up that data center miss by saying, okay, our investments in AI aren't really paying huge dividends yet. And so naturally, the thing you would expect them to do is to massively increase their investments in AI. Wait, what? Yeah, that's what they did. $100 billion in CapEx for 2025, Amazon just announced. And congratulations, Amazon. You have now thrown the biggest pile of cash onto the bonfire in this massive game of CapEx chicken. Guys, we've seen this pretty consistently among the hyperscalers, the Mag 7 names, Google, Microsoft, and Amazon. All three of them posted disappointing cloud revenue numbers. All three of them posted big increases in their CapEx, or at least maintain their commitments to their CapEx. So, not a whole lot of talk about DeepSeek. There was a little bit of token reference to Jevons paradox once again on Amazon's earnings call yesterday when they said, yeah, DeepSeek means it's going to be more efficient and it's drastically cut down people's compute requirements. And therefore, people are going to consume more compute. Look, they're betting $100 billion worth of the farm on that. Better payoff for them. That is a bold move. So Amazon's down a little bit this morning. Big tech earnings overall have been pretty disappointing this season. They haven't been dreadful. I mean, I'll say that the earnings have been beats. The revenue has been mostly beats, but pretty consistently, we're still seeing that AI is not yet paying dividends for any of them. And yet they're all pumping more money into it. Despite this DeepSeek story, I'm sure it's going to end really well for everybody though. Some other stories going on this morning. We've got Nicola. You guys remember Nicola? That was the big EV truck company that Hindenburg Research came out, did a report on them. The CEO got accused and convicted of fraud. Whoops. And then they decided, no, we're not an EV truck company. Now we make hydrogen trucks. Well, now the rumor is they're going bankrupt and they're going to make no trucks. Hasn't been confirmed by the company yet, but that stock was down over 40% the last time I looked. Looks like Nicola is going bankrupt, and rightly so, for companies that are engaged in widespread fraud. Once again, shout out to Hindenburg Research for everything that they have done. Some big shoes to fill over at Hindenburg. Also, keep an eye on the Japanese yen, guys. We've seen a sudden strengthening in the yen over the last month or so. It hasn't been as pronounced as in the middle of last summer, like that August panic that we saw. But ever since Trump took office, ever since the tariff talk has moved front and center, we have seen a strengthening in the yen. And we've got people expecting some hawkish moves by the BOJ very soon. So keep an eye on that one. That is a risk to the markets. We've got the central bank in India is cut interest rates by 25 basis points. Yet another central bank cutting rates. And last but not least, we've got Liberated Brands. Keep an eye on that one. Liberated Brands. That's the parent company of names like Quicksilver, Billabong, Volcom. Every store in the country is closing as that company is now in Chapter 11 going bankrupt. So look, with that one, Billabong, Quicksilver, I don't know, is this indicative of the consumer environment? Is this indicative of people just have no money to spend on apparel and inflation and high interest rates? Or maybe this is just a sign of kids don't want to wear the same logos as their parents. I mean, Quicksilver and Billabong were pretty big when I was a kid. Maybe these brands have just run their course and they're just not edgy enough. So maybe we don't look too much into that story, but that's about 100 stores closing, probably somewhere around 2,000 jobs going away. We got a lot to talk about once again. Why don't we shrink my big melon of a head And let's see what's going on in markets this morning. Guys, don't forget that like button for the YouTube algorithm. And if you're new here, hit that subscribe button because we do this one every day. And right now we've got the S&P 500 is up 4 points. We are just barely positive here, up 0.07% ahead of the opening bell. You can see this initial candle when the jobs report came out. Look at the size of the wick above and below. This is how much the algorithms couldn't quite make heads or tails of that jobs report and those big revisions in the first few minutes. And now we're basically settling unchanged here. Same story with the Dow. The Dow is just barely positive, 33 points to the upside or 0.08% higher. And the NASDAQ is also up by 0.07%, 15 points in the green this morning. So a little bit of volatility and then pretty much no reaction whatsoever to this jobs report. Meanwhile, we've got a U.S. dollar that is slightly stronger this morning, still below 108, 107.79. That's up by about 9 basis points. Once again, some volatility on the release of that jobs report, and then it's settled pretty much unchanged. Looking over at the bond market, we are seeing a move in bonds here. We've got yields are higher, particularly on the long end of the yield curve. We got the 30-year Treasury 4.696. That's up almost 5 points. The 10 years at 4.490, up 5 points. We've also got the 2-year Treasury 4.266, up almost 6 points here. And the 1 month is at 4.329, up just about 2 points here. So yields moving higher across the board here. That's bond prices heading lower. So a little bit more risk appetite this morning, possibly off of this. That's interesting. Looking over at the commodities board, not a whole lot happening there. We've got gold is higher again, $2,865 for spot gold. That's up by about $10. So much for that risk appetite. Gold a little bit higher. It's been a fantastic couple of weeks for precious metals here. Silver also up this morning, $32.35 for spot silver. That's up another 13 cents or 0.44% higher. We've got copper's up by 2.8% here. Platinum's up about 0.8%. Palladium's down almost 1%. And oil's a little bit higher this morning at 71.17 for March WTI futures. That's up about 55 cents. Looking over at Bitcoin, it's moving a little bit higher on this jobs report here. Still below that 100,000 threshold. But you may notice we have now retaken the 50-day moving average. That's an important technical indicator there. $99,793 as priced on Coinbase for Bitcoin. We had failed below that 50-day moving average for a couple of days there. I watched us come up and fail to recapture that level a few times. Things were not looking good, but I guess this jobs report is being interpreted as bullish for Bitcoin overall, an inflationary report. All right, so let's talk about the non-farm payrolls. This is from the Bureau of Labor Statistics. This morning, the U.S. economy added 143,000 jobs in January, well below an upwardly revised 307,000 gain in December and forecasts of 170,000. And guys, I know I said it before in the opening. I got to say it again. 307,000 jobs gained in December. Tell me that September rate hike wasn't not a hike. I'm sorry. That 50 basis point cut in September. Tell me that wasn't a gigantic mistake without actually telling me. 307,000 now for the month of December. Good God. Job gains occurred in healthcare, 44,000, retail trade, 34,000, social assistance, 22,000, and government employment continued to trend up at 32,000. Employment showed little change in construction, manufacturing, wholesale trade, transport and warehousing, information, financial activities, professional business services, leisure, and hospitality. The BLS published the annual benchmark revisions for 2024. That's important also to note there, guys. They reset their population and their workforce numbers. So a lot of those attachments and that data has changed significantly here. It's going to take some time to digest those numbers. If I find anything in there, I'll point it out. But the change in total non-farm payroll employment for November was revised up by 49,000 to 261. And the change in December was revised up by 51,000 to 307. Those cumulative 100,000 in upward revisions, that seems to be dominating the airwaves and the news around this jobs report. Also of note here, the unemployment rate dipped by 0.1 percentage points to 4.0% in January of 2025, marking its lowest level since May and coming in just below market expectations of 4.1%. The number of unemployed individuals declined by 37,000 to 6.85 million, while employment edged up by 2,234 to 163.9 million. So we've got a falling unemployment rate 2 months in a row now at 4.0%. That is the lowest that we've seen since May of last year. On the participation front, the labor force participation rate in the U.S. edged up to 62.6% in January 2025, up slightly from 62.5% in the previous month. So we had spent 3 months at 62.5%. Now we ticked up a little bit here. Again, participation rate going up. That's interpret that as bullish for the economy. Now, the one negative point here, we talked about this in the monologue, is average weekly hours. This is, I would say, the one weak link in an otherwise very good report here. The average work week for all employees in the United States, private non-farm payrolls, edged down by 0.1 hours to 34.1 hours in January of 2025, compared to market forecasts of 34.3. So you can see here, it dropped by 2 because in December we were at 34.3. So we dropped down by 0.2 hours to 34.1. Now, looking at this data set, maybe that doesn't seem so alarming here, right? Yeah, it's the lowest we've been in a year, but still pretty close to where we've always been. But let's zoom out a little bit. Let's look at a 5-year chart. Now you can kind of see how American workers, since the peak in the first quarter of 2021, have slowly seen their hours cut back. And now we had bottomed out at 34.2 hours several times last year. We have now broken below that level. And if we zoom out 10 years here, you can see other than the peak of the pandemic hysteria in 2020, we have not been this low, well, ever. We come all the way back. Okay, not since the GFC have we been below this level of 34.1 hours. And even then, we were only below this level at the peak of the GFC when unemployment rate was, well, a whole hell of a lot higher than it is right now. So again, if you really want to look for the gray lining of this big silver cloud, this is it right here, those weekly hours. I'd be looking for that to recover in future job reports in order to signal things were all clear. All right, now let's talk a little bit about Amazon's earnings. Amazon's share price drops after key division misses earnings as investors get jitters over AI spending. And guys, this is a pretty generic headline. You could replace Amazon with Microsoft. You could replace Microsoft with Google, and this would be accurate, and this story would read virtually identical because we have now seen this pretty much exact report from 3 of the Mag 7 here, all very similar themes here. Tech giant Amazon has seen its share price drop overnight after an earnings report missed analysts' expectations amid ongoing concerns by investors over spending on AI. Now, I just want to clarify something in the first paragraph here. Earnings did not miss expectations. Earnings were above expectations, and revenue was above expectations. It was just one little subset of that data, and it's a very important subset. The cloud revenue, that's what missed expectations. Amazon Web Services, the cloud computing arm of the company, which is responsible for between 15 and 17% of total revenue, generated fourth quarter revenue of $28.79 billion, and that is ever so slightly below Wall Street's estimates of $28.84 billion. So you can see, about 500 million they missed by on AWS, and that was enough to send the stock lower and make everybody overlook an otherwise very good earnings report. The immediate concern for investors appears to be the huge expenditure on AI capacity, which is the biggest companies in America are betting yields them enormous long-term rewards. However, that is not yet translating into increased growth, with Amazon now following the same fate as Google owner Alphabet and Microsoft in seeing a fall in share price. And I just want to point out here, guys, this was another big takeaway. Amazon has topped the pack with guidance for approximately $100 billion in CapEx in 2025, the vast majority going on AI for its cloud division, AWS. It's splashing the cash on data centers, hardware chips, and networking gear to further lay the foundations to serve what it expects to be a gigantic wave of demand. That's a huge outlay to stomach now and then a waiting game before it gets a positive financial return on the investment. So, the whole point here, guys, the first negative was disappointing cloud growth. And then they announced a much bigger investment in future cloud growth, which just disappointed. So, Amazon is literally throwing money at the problem here, and investors are starting to be weary of this. We've seen this with Google, we've seen this with Amazon, and we've seen it with Microsoft here. Stock right now is down 3.17% ahead of the open. Let's refresh that because it's been a pretty volatile morning. All right, down 2.75% here, trading at $232.28. It's off by about $6.55. Now let's zoom out by a year on the chart here, guys. Amazon stock is up 41% over the last year. So let's keep this sell-off in context. Okay, it's down a little bit, but still way up on the year. Look at a 5-year chart. Amazon stock is up 132% over the last 5 years. So, I mean, this is hardly the end of the AI mania, but what's going on? Do I have I don't know what's going on. My iPad just told me something's up with the chart here. Just reset. We're going to keep going with the show. I think we're all right. All right. Sorry about that, guys. Anyways, Amazon stock, I'm not too excited about this sell-off. It's down 2.75%. But the bubble has not burst yet. That's the point. Maybe DeepSeek ends up bursting it, but these earnings are not going to be enough to do that. All right, let's also talk about Nicola here. I got a text from Mish. Okay, Mish says you're fine. Thank you, Mish. Nicola shares are slumping. A report says the hydrogen truck maker is nearing bankruptcy. And this one is near and dear to me because, again, of Hindenburg Research, who recently shut down shop. Nicola was one of the first ones that Hindenburg exposed as a total fraud. They were making EV trucks. Hindenburg exposed them as basically faking all their demos. And then, of course, Nicola crashed on that news and they said, oh, we're not an EV truck company anymore. Now we make hydrogen trucks. Well, now they're a bankrupt company. Now they make bankruptcy settlements. Shares of Nicola tumbled Friday after a report surfaced that hydrogen truck maker is close to filing for bankruptcy. Nicola is working with the law firm of Pillsbury, Winthrop, Shaw, and Pittman over a possible sale of or restructuring, the Wall Street Journal reported, citing sources. In 2020, the once high-flying EV maker became the target of activist short seller firm Hindenburg Research, which recently called it quits. The startup was accused of misleading investors over the functionality of its vehicles. A year later, Nicola founder Trevor Milton was hit with federal fraud charges and later convicted. And this one I actually do like to see. Nicola stock down 41.5%, trading at just 44 cents here. Look, this company was caught committing fraud, and frauds deserve to go bankrupt. So do I like to see people losing their jobs? No. Do I like to see people losing money? No. Do I like to see frauds in handcuffs going to jail and their companies going down in flames? You better believe it. And so once again, shout out to Hindenburg Research. Thank you for the excellent work. You will be missed. And let's talk about this one here. All Quicksilver, Billabong, and Volcom stores to close in the U.S. Altogether, over 100 stores for the brands which sell apparel for skaters, surfers, and snowboarders will close their doors. All Quicksilver, Billabong, and Volcom stores in the U.S. will close after their operator filed for bankruptcy protection. Altogether, over 100 stores for the brands that sell apparel for skaters, surfers, and snowboarders will close their doors. Liberated Brands filed a voluntary petition for Chapter 11 bankruptcy protection on Sunday in the U.S. Bankruptcy Court in Delaware. Now, according to Todd Heimel, the CEO of the Costa Mesa, California-based company, he said in a declaration of support for the bankruptcy filing that rapid and dramatic rises in interest rates, inflation, supply chain delays, a decline in customer demand, and shifting consumer preferences cast significant pressure on the operator. Look, all those things are perfectly legitimate reasons why an apparel company may be going bankrupt. It's also possible that these brands are just too old and they're not edgy anymore and they haven't adapted, and so they're going out of business. So I wouldn't read too much into this one. We have seen a lot of retail store closures over the last year or so, but I would say that the pace of that has slowed somewhat in the beginning of the year. I was actually expecting a surge of that in the beginning of the year. It hasn't materialized yet, but we will keep an eye out for stories like this. We've got the Reserve Bank of India has now joined with the central banks around the world in cutting interest rates. The new RBI governor takes measured tone with his first rate cut. The Monetary Policy Panel voted unanimously to lower by 25 basis points. The central bank projects GDP growth of 6.7% in the coming fiscal year. So not a whole lot of news here. This was largely an expected move. But again, more central banks cutting rates, even though 6.7% economic growth. I guess that's slow growth for India, but that's pretty good by Western standards. And yet they are cutting rates. They will choose to deflate every time, every single time. I'm sorry, they will choose to inflate every time. There's that dyslexia striking again. Yen's weekly surge underscores growing case for a hawkish BOJ. And the BOJ is, of course, the one exception. We've got dovish central banks all around the world. Everybody's cutting. But remember, guys, the Bank of Japan, they may be hiking here. And the yen has been surging in the last week or so, anticipating that. The yen is on track for its fourth straight weekly gain against the dollar, as spending data on Friday added to signs that the Bank of Japan will raise interest rates again. After a sharp decline at the end of last week, the yen began rallying Monday when it showed haven appeal on broad dollar strength amid Donald Trump's tariff threats. Gains gathered momentum Wednesday when Japan's wage growth jumped by the most in nearly 3 decades and accelerated further on Thursday as BOJ Hawk said that borrowing costs should be doubled to at least 1% by the end of March of 2026. So we got some hawkish rhetoric from the BOJ. We've got some good economic data showing wage gains going up in January. And now we've got a lot of traders are starting to bet on the yen strengthening. More hawkish headlines from Japanese officials on domestic policy rates have created some enthusiasm for the long yen trade, said Jerry Minier, co-head of G10 FX trading at Barclays. We think this is driven more by the yen than the dollar, as there have been a considerable pickup in interest from clients for buying the yen against other currencies. So this is important to keep an eye on here, guys, because they're talking about the long yen trade. Keep in mind, a lot of this big rally in U.S. tech stock has been built on the short yen trade or the yen carry trade, where people borrow yen, convert to dollars, and then use those dollars to buy U.S. risk assets. So if we have this emerging trend of a long yen trade that could contribute to an unwind of that yen carry trade, and remember the unwind of the yen carry trade, that's what gave us that panic back in August, that sudden strengthening in the yen. This is the chart of USD JPY. When you see this chart moving lower, that is the yen strengthening against the dollar like it did in August, leading to that panic on August 5th. Now, ever since then, the yen has weakened again, but you will notice that in the last month or so, ever since Donald Trump took office and the tariff threat became a thing, we have seen the yen strengthen considerably against the dollar, in particular in just these last few days. That remains a risk to stocks that is not priced in. So keep an eye on that USD JPY chart, guys. That is a sleeper that is always out there. And we recently broke below the 200-day moving average on this chart. So that could indicate that this one is heading lower, which would put pressure on U.S. risk assets. And I just want to say thank you very much to ABD Spartan. Thank you, sir, for supporting the channel. He said Fed will hold rates and then panic cut as it is behind the curve and acts to stave off real asset deflation. Long-term treasuries will come down with CRE. Excuse me for that. Okay, ABD Spartan, a lot to unpack there. Fed will hold rates. I agree with that. I don't think the Fed is in a hurry to do anything here, especially because I think they're going to get a lot of criticism for that September rate cut, especially in light of these numbers. So I agree with that. Then they will panic cut as they're behind the curve. The Fed is always very reactionary. I agree with that sentiment as well. They tend to react versus pre-act. So yeah, a panic cut. I think when things get bad, the Fed has shown us over and over again that they will immediately flip dovish and support markets with lower rates or quantitative easing if need be. They might create a new acronym, call it something else, not QE, but it's what it is. So I agree with that as well. Acts to stave off real asset deflation. Absolutely. I mean, the Fed will not tolerate any asset price deflation at all. I mean, deflation is this boogeyman to the Fed. I mean, we're still sitting here well above the Fed's inflation target. We're still heading in the wrong direction away from the Fed's inflation target. And they're still telling us, don't worry, we have a plan to hopefully someday get there, maybe by the end of a couple of years from now. And yet anytime inflation goes anywhere near 2%, they're like, oh, hurry up and stimulate. We can't let inflation go even a little bit below our 2% target. So I agree with that as well. They will avoid real asset deflation as long as humanly possible. Long-term treasuries will come down with commercial real estate. So when you say long-term treasuries will come down, are you saying yields will come down or prices will come down? Because if we have a panic in commercial real estate, you could see people run to safety and start bidding up the prices of long-dated U.S. treasuries. That could see the yields come down, but the prices head higher. Or you could see something like a panic for liquidity. If people are desperate for dollars to maintain their CRE investments, or people are desperate for dollars and so they're panic selling their CRE investments, you could actually see the opposite. You could see interest rates blow out as short-term cash becomes much more desirable than long-term treasuries, and the price of money is interest rates. So you could see borrowing costs surge there. I could see either scenario playing out, to be honest with you there. There's a lot to unpack in that comment, but I agree with pretty much all of it, ABD Spartan. Thank you very much, sir, for supporting the channel. And, on that commercial real estate subject, guys, that story's not over. It's fallen from the headlines, but this whole avoid price discovery at any cost, it's still going on in commercial real estate. They're still sitting there acting like these buildings are worth more than they're really worth. They've gotten away with it for years. I don't know how, mostly by parking it in your retirement accounts. But keep an eye on that. If you're wondering who owns this crap, chances are the answer is you. Thanks again, ABD Spartan. And thank you, Chuck G. He says, I drive a Nicola truck for my company. These trucks are comfortable AF. Really? Okay. Is this a hydrogen Nicola or an electric Nicola? It also drives and rides better than a diesel truck. The only downside right now is the fuel cost for hydrogen. Okay. So you answered my question. It's hydrogen. Yeah, look, I think hydrogen trucks, there was a lot of investment in that with the Inflation Reduction Act. I think the Chinese may have put the final nail in the coffin of the hydrogen truck here, because the Chinese, they did shift away from diesel, but they went to LNG. And if you've got the world's second largest economy has made a concerted effort to transition to LNG, that means you're going to get more investment in that space and less in the hydrogen space. So at this point, if I had to pick an alternative fuel source truck, and I had to pick between electric, hydrogen, and LNG, I would probably go with LNG personally. Although I'll be honest with you, if I had to pick any truck, I'd go diesel every day, all day. Yeah, I think hydrogen. Look, Nicola was always going to go under. That's a company. That name was toxic. Nobody was going to touch that company anyway. But I think the hydrogen truck here just probably never really had a chance. Thank you very much, Charles, for supporting the channel, sir. And thank you, everybody, for putting up with my sore throat this week. You guys are awesome. I appreciate all the support of the channel and you guys sticking with me while I was under the weather. Thank you also for the super chats and the support of the channel, guys, as well as my Patreon supporters and magnanimous melonheads on YouTube. Looking forward to talking to you guys at 2 p.m. Eastern time today for our weekly get-together on Zoom. I got links down below should you feel so inclined. Don't forget that like button and that subscribe button on the way out. Hi, Mom. Hi, Dad. I love you guys. Everybody, till next time, live small and dream big.